One of the highlights of the conference every year is the panel discussion. This year's topic, I think, is especially timely. It's inflation news and financial markets. We have an extremely distinguished group of panelists and an equally distinguished moderator, Charlie Calomiris, who's going to introduce the panelists. I'll introduce Charlie. So for those who don't know, he's the Henry Kaufman Professor of Financial Institutions here at Columbia, and his research spans the areas of banking, corporate finance, financial history, and monetary economics. He's a distinguished visiting fellow at the Hoover Institution, a fellow at the Manhattan Institute, a member of the Shadow Open Market Committee and the Financial Economists Roundtable, and a research associate of the NBER. So Charlie has tons and tons of awards. Many of them come from his recent outstanding book, Fragile by Design, which I read, even though I'm not like a banking expert, but it's a fantastic book. It's on the political origins of banking crises and scarce credit. And I'm blessed to have had Charlie as my colleague for the last 15 years. And like all of us, I'm very much looking forward to the panel discussion. So Charlie, if you're ready.
Thanks, Paul. I'm definitely inviting you over to dinner to talk to my wife after that introduction. Thanks so much. It's such a pleasure to be here. You know, when I talk to people about the News and Finance Initiative at Columbia Business School as part of the program in financial studies, I say it's the best conference I go to in the year, not just the best conference at Columbia, not just the best academic conference, but really the best conference. And those of you who are alumni of this conference know that what I'm talking about. So it's really an honor and a privilege, a pleasure, all of those, to be here. Also, we have a really interesting topic for the panel and a really interesting group of people who are bringing together a very different set of perspectives on, I think we can all agree, an absolutely important issue. In fact, we have to give the organizers credit for having figured out that this was going to be such an interesting topic. I'll talk about that in a minute, because I think it was actually not so hard to figure out how important this topic was going to be. So let me first talk a little bit about the people who are joining us. Coral Murphy-Marcos is a business reporter at the New York Times. She is a print business journalist based in Puerto Rico. She's going to be completing her MA in journalism at UC Berkeley this year. And one of the things that she particularly, I think, will be talking to us about is how to try to make sense of connections between news and changing viewpoints about inflation and their effects on financial markets, especially the stock market. Jeffrey Meli is head of research at Barclays Investment Bank. Jeff is a managing director and co-head of the FICC research at Barclays. He's based in New York. He's a University of Chicago PhD in finance. Prior to coming to Barclays in 2005, he worked at Deutsche Bank and JP Morgan. He oversees credit, emerging markets, foreign exchange, and technical strategy research teams globally, and is a publishing analyst too. Nida Melek is a senior economist at the Federal Reserve Board. It says here, but actually she was at the Federal Reserve Board as a visitor, and she's back at the Kansas City Fed, where she's a senior economist in the research department there. She specializes in macroeconomics, international economics, and energy economics. I see her as one of the top people in the Federal Reserve System, actually involved in trying to track energy markets as part of the Fed's overall macroeconomic focus. She joined the Kansas City Fed in August 2013 after getting her PhD from UCLA. And finally, Mickey Levy, chief economist, Americas and Asia for Berenberg Capital Markets, LLC. He used to be chief economist for many years at Bank of America. He's a longstanding member of the Shadow Open Market Committee and is also on the advisory board of the Office of Financial Research. So as you can see, we have a really interesting and diverse panel. What we're going to do is each of our panelists will speak initially for a few minutes, followed by their answering a question I'll pose to them, and then we'll open it up to Q&A from the conference participants. This panel follows the tradition of the News and Finance Conference of looking carefully at how various players in the public conversation about finance interact in the media. And speaking to the panelists in advance, I know that they're going to raise many interesting issues which relate to their different vantage points. But I want to tee up the discussion, and of course, this isn't the only thing we're going to discuss, with an observation and a question about the topic, which is inflation. The discussion of inflation by the Fed, by most macroeconomic forecasters, and by the media over the past 18 months has exhibited a colossal failure. A failure to recognize the reality of a forecastable, and I want to emphasize forecastable, acceleration in inflation. To those of us who've been paying attention to this discussion, the errors have seemed to be worse than can be explained by normal human error. Why has the thinking been so bad? Has groupthink played a role, or even worse, some sort of self-interested dishonesty by forecasters and reporters seeking to, for example, as we know, there's a tradition of this, preserving access to Fed officials or seeking to avoid the risk of having their forecasts stray too far from a Fed-created focal point. So I put that out there as a controversial hypothesis that I hope we will gravitate back to at some point. So let's just, with that, start off and let Coral, would you take a few minutes to make your introductory comments? Then we'll go on to Jeff, then Nida, and then Mickey. Thanks very much.
Hi, everybody. Thank you so much for taking the time to be here. As Charles said, my name is Coral Murphy. I cover business at the New York Times. And I think it's really important, as Charles posed, not to sort of lean into this groupthink. I think I start the morning when I start my story. It's really important not to come into any type of conclusion immediately, especially when you're covering this every day. You think you know what's going to happen, but you really don't. So it's really important to start the day by calling people up. I really enjoy my job because most of it is talking to economists, portfolio analysts, and just different diverse types of people to get a sense of what's going on. And especially when you're covering inflation and how that's affecting Wall Street and Wall Street behavior, it's really important to talk to as many people as possible before you really start writing up your story. So I think with that, it's been a heavy couple of months, especially covering Wall Street, as in you really don't know what's going to happen each day. So you really need to do your homework on not only what's looking back on what's happened for example, the last quarter, but what's happened in the last month and even the last week. Things can change so rapidly. And as I said, it's really important just to talk to as many people as possible. Talk about maybe what the consensus is in your story, but also insert that but X, Y, or Z person said this as well, to sort of highlight that there's different types of ideas and hypotheses going around, and really not lean into this is the only thing that's affecting Wall Street. So I just wanted to really highlight that. And yeah, thank you again for, if there's any questions regarding that, feel free.
Well, we'll come back to that. Let's move on to Jeff. Jeff, would you like to start us off?
Yeah, sure. I'll speak about some of the narratives that we're seeing on inflation and think about them in the context of market pricing and how those narratives might shift. I'm going to talk about two, which I'm going to make up names for. One I'll call the transitory narrative, and one I'll call the political narrative. Transitory narrative, I think, really attributes the surge in inflation to supply chain disruptions. Maybe in its simplest form, supply chains by themselves led to inevitably to higher prices. I think that's probably too simplistic. It misses the really unprecedented surge in demand for goods in the US, which I think had an outsized effect on prices because of challenges in supply chains. There's an interesting anecdotal example around Malaysia and semiconductors, where obviously there was a big increase in demand for semiconductors. Malaysia plays no real role in the production of semiconductors, but they do in the packaging, and they had shutdowns linked to COVID, and that exacerbated sort of the challenges. I think that nuanced view does a reasonable job of explaining maybe the initial impulse, and you can see why people maybe convince themselves that it was transitory. Supply chains eventually normalized. The surge in good spending likely linked to the stimulus checks that were part of the COVID relief bills. That's unlikely to be repeated as well. So stimulus, that impulse is likely to fade, and you can see why then one might conclude that inflation itself would fade with it. Obviously, it's taken quite a bit longer than most forecasters and companies and commentators believed would be the case. There's lots of possible reasons for that, but obviously it's taken so long that the Fed itself has dropped the use of the term transitory, and of course is in the course of raising rates and then eventually engaging in quantitative tightening. Rates markets have adjusted, but if you take a closer look at market pricing, it's actually they've adjusted to quite a limited extent. So I had written down that rates markets reflected a terminal rate of only 2.6%. That was before today's news, and that's probably I haven't had a chance while listening to this to rerun any numbers, but my guess is it's slightly higher after today. But even so, that's actually more dovish than the Fed's own forecasts. And if you think about 2.6% as a terminal rate in the context of 8% inflation, that's really kind of a shockingly low terminal rate that we're looking at. And what I would interpret that as saying that investors have not actually given up on the transitory narrative, even if the term itself may have fallen out of fashion. Prices suggest that really only modestly tighter monetary policy conditions will be sufficient to get inflation back to the target range. Implicit in this is sort of obvious sources of a vicious cycle, like a wage price spiral won't come to pass. You see today in the news, the wage growth is accelerating despite increases in labor force participation. We still have a fair bit of to go on the labor force participation, at least if it's going to recover all the way to pre-COVID levels. There are many missing workers, so-called missing workers, I guess. Our analysis suggests a lot of them come from two-income households. It's not outrageous to say that inflation itself might even draw some of these people back to the market. But I would also point out that, without wanting to lean too heavily on cross-market signals, equity markets would suggest that that companies that are reliant on, say, for example, low-wage workers, their equity prices have underperformed, and I think you could maybe plausibly interpret that as saying that other markets might suggest these pressures could last longer than maybe the rates market suggests. But I also think there's another narrative, and I think that's kind of interesting because it has been in the news a lot, and I think it's used a lot. I call it the political narrative. That's that companies with market power will take advantage of these conditions and drive inflation by raising prices above their input costs. I call it the political narrative because it's been raised by the Biden administration to try to help explain the surge in inflation that we're experiencing. I think so far that narrative was dismissed by markets. I think for good reason. Almost surely that has not been the source of inflation to date. You could look at things like Q4 margins in the latest earnings season. You'd see that margins are down, and they would have been down even more, but for a really significant inventory drawdown. That's not what you would expect if companies were increasing profitability because they were taking advantage of all of this generalized inflation. But I also think it doesn't mean it won't happen. And I think that's where the timing on these narratives becomes really interesting because whilst we would disagree with the administration on the breadth of market power, we don't disagree that there are industries where it is likely real. And raising prices may be more successful at supporting margins going forward than doing other things like trying to keep wages low in the context of a really tight labor market. So when we think about inflation, we think that the risk is that the drivers of inflation can change over time and maybe in some unexpected ways. And that this transitory narrative, which again, I think really effectively holds in the market, even though the term itself isn't really used, could be even more wrong than we realize. And as it's wrong, it creates room for some of these other effects to kick in. I'll stop there, Charles.
Thanks very much, Jeff. Let's move on to Nida. Nida, would you make some comments?
Absolutely. Thank you, Charlie. And thanks, everyone. It's a great pleasure to be here. So what I will talk about is actually overall, energy market developments, their implications for inflation. So energy prices were on an upward trend, before Russia's invasion of Ukraine. So coal, natural gas, crude oil, all actually surged really unprecedented levels in some cases. And overall, just like focusing, for example, oil markets, what was happening was not very different from actually what was going on in the rest of the economy. In the sense that there is, tightness in the market, so supply not catching up with, a strong rebound in demand. So the expansion in supply was limited because in the sense that there was years of underinvestment, the pandemic, as well as the industry's poor recent returns. When you look at, for example, oil demand, on the other hand, and just let's focus on, for instance, US, which is world's largest producer and consumer of oil and other petroleum liquids. Oil demand, total products supplied, or road traffic volumes actually have recovered to pre-pandemic levels. On the other hand, US supply or world supply are below pre-pandemic levels. Then the invasion triggered further increases, for example, in prices like crude, Brent crudes reaching levels not seen since the GFC, driven by concerns over Russian oil supply disruptions in an already tight market. So, for example, in the aftermath of the invasion, the International Energy Agency reported seeing a potential loss of 3 million barrels of Russian oil supply, which is about 3% of global oil supply starting from April. So what that meant was that actually this is potentially meaning like the largest the worst, potentially the worst energy crisis in decades. But I just want to highlight that, for example, in previous crises, it was mostly about oil. But Russia is one of the world's leading exporters of almost every form of energy. It's coal, it's natural gas, it's crude oil. It accounts for more than 10% of global oil exports, close to 20% of global natural gas exports, and about 15% of global coal exports. And Europe is Russia's main market. So, I mean, lately the prices have come down a little bit, but of course they remain above pre-invasion levels, and disruption risks are still present. And there aren't so many options to actually replace potentially low supply. So, of course, overall, what this means is, inflation. So higher energy prices are a risk to US inflation. And as I showed this, there was a significant increase in prices. When we look at, for example, year-over-year change in headline CPI, it was 7.9% in February. And the average year-over-year contribution of energy goods and services to headline CPI since February of last year has been about 1.5 percentage point, with a range of 1.5 and 2 percentage points. So now energy prices are even higher. So that's happening in a situation when there was already a lot of public attention and focus on inflation. So it was raised the risk on the idea that inflation expectations will become even much more sensitive to realized inflation. And near-term expectations were already very high, and they are quite sensitive to gasoline prices, for example, which also, of course, given the increase in crude oil prices, they also increased quite significantly. So we haven't seen much of an evidence regarding longer-term expectations, rising significantly yet, but there are risks given what's happening. But just before actually concluded, I just want to highlight it. It's just not energy, right? Because Russia and Ukraine are also major exporters of several metals and agricultural commodities, such as, for example, palladium or wheat, and both metals and agricultural commodities also, increased even further with the invasion. So this means is that there are potential risks from supply chain constraints and also rising costs, right? For example, auto production already struggling, as Jeff mentioned. For example, in the US, majority of palladium used in the US comes from Russia, or raising agricultural prices, and upside risks of food inflation. So there is also a risk from transportation costs, as which were already again quite elevated. They may rise further due to disruption to shipping, or also rising fuel prices, of course. So overall, I think it's not only energy prices, of course, but also higher production costs due to rising commodity prices, or higher food prices, or increased transportation costs. This all can actually bring up inflation even much higher levels. I'll stop there, Charlie. Thanks.
Thanks very much, Nida. Let me turn to our last panelist, Levy.
Okay, Charlie, thanks a lot. And I note that your all-day conferences on, kind of how does the news move markets, but this session's on inflation news and financial markets. And it's just absolutely stunning how the bulk of the economics community, researchers, and the media have completely been behind the curve and not understood what was unfolding. And I think it was a lot of complicity going on. And when I think about, so I must go back. I wrote my first research paper in July of 2020, warning of high inflation. And it was just so obvious because I based it on old-fashioned fundamentals. And it was a very lonely position and remained lonely for a long time. And when I think about why the media didn't capture it and why economists didn't capture it is a lack of a sense of history, very little incentive to learn the details of historic context. Everybody had this presumption that, we would just follow the same subdued inflation that happened after the post-financial crisis without any regard to why inflation didn't rise then and why it did in the 1970s. And I think people have this predetermined view of an issue. They conduct their interviews talking to certain experts. And when we think about particularly the media and the inflation issue, I consider, not just the Fed, but a group of what I call the Fed consensus, which includes most of the chief economists on Wall Street who are trained at the Fed and have the wrong analytical model, and the media just interviews them, doesn't talk to anybody else, and they ignore the facts. So let me just give you a good example. Last fall, when the Fed and the White House were just saying, oh, the inflation's just due to spike in prices of a few items. And as Jeff noted, it was the kind of transitory narrative. I developed a simple algorithm where I downloaded over 200 components of the CPI and just showed how the price increases were becoming extraordinarily pervasive.
I remember.
And I actually showed this to not just Fed members, and some of them bought into it, but I showed it to leading members of the media at the Wall Street Journal, the New York Times, and Bloomberg, and they refused to report on it. I won't use the word refuse. They just didn't think it was important that the facts mattered. And I could go through so many different reasons. And it's really, Charlie, I can stop there, but it's really quite perplexing how everybody missed the notion that the unprecedented amount of monetary stimulus and the unprecedented amount of fiscal stimulus, people's forecast that inflation would stay low implied that the fiscal policy multipliers would be close to zero. Where's the sense of history here? And why didn't anybody in the media ask even the simplest questions? And it's really quite striking. So here we are. So I'll just conclude with the famous quote from Rudy Dornbush in economics: things take longer to happen than you think they will, and then they happen faster than you thought they would. And maybe underlying that quote is not just a failure of economics and forecasting, but a failure in the media in really digging under things and asking the right questions. And so maybe the lag in the news is part of the complicit in the predicament we're in now. So right now we're, having been in denial, now markets are adjusting, as Jeff said, much more quickly, and they probably have a long way further to adjust. So I'll stop there.
Thank you very much. And I appreciate all the panelists sticking to the time constraints. I want to ask a few questions, one of each of you. Coral, let me go back to you and start. You know, one of the things you emphasized was how you're committed to talk to a diverse group of people and not to have a preconceived idea at the beginning of the day what the right story is. But how do you decide what that diversity consists of? Where's that Rolodex coming from? How do you make sure that the views are representative?
Yeah, that's a great question. I think first of all, first and foremost, it's really important to read other news outlets, not just stick to your own and read your own reporters reporting. So go to the Wall Street Journal, go to Bloomberg, so many other news outlets that quote so many smart people, and just doing that day-to-day practice is really helpful because I come across so many economists every day that just have really insightful ideas. So I write them down, I do the homework of reaching out to them and say, hi, my name is Coral Murphy. I would really like to chat with you, just an introductory call. And they almost 99% of the time end up really well. We have a call, and then every time I need a voice, depending on the day, I have this contact that I know I can rely on. So it works out really well. And sometimes most of the time they are really understanding on the time constraint. For example, sometimes if I'm writing a story on Wall Street's behavior and I need, say, a comment within 2 hours, most of the time they're extremely helpful in responding within that time constraint. And not only do I also try to bring women and minority voices into my reporting, but also different types of job positions. So depending on the day, if it's, for example, a Fed-focused day, I try to lean more towards economists, not so much portfolio analysts. And depending on whether it's an inflation story or supply chain constraints, I try to reach out to someone, say, who's an expert globally on supply chain, not just stick to economists or stick to analysts. Try to see if I can find someone who focuses specifically on that topic. For example, oil, which was a really big beat, it has been a really big beat because it still continues within the last several weeks. I try to see if I can talk to someone who's mostly focused on energy markets and not just stick to the US. I try to see if I can have a wide array of ideas, say globally, talk to someone in Europe, talk to someone in Asia. What are they looking at? They might look at it with a different lens than someone in the US. And I think having that different, not only position-based variety and diversity in my reporting, but also just try to look at different countries and see what other ideas I can incorporate in my reporting.
Thank you. Jeff, let me ask you, I thought your discussion of these different narratives was very enlightening. And there was an admission there, though, when you recognize that people sort of miss the demand surge. And I think that's the part that I find hard to understand, because it wasn't like the fiscal package was a secret or the stance of monetary policy was a secret. There was a huge amount of basis for observing the expansion demand, and then we saw it happening in the nominal GDP growth. So what do you mean when you think about missing the demand surge? How did we miss that?
You know, it's a very interesting question. I think that the part of it may have been, I think some of what you were referencing before in terms of there being a sort of a common framework in the way many forecasters think, and I do believe that likely played a role, and it is the case that, you know, I'm not a forecaster myself, but I employ a bunch of them, and most of them do come from the Fed system and have a very common framework. And so I'm sort of sensitive to that point. I would say something else though, which was different about this in a way that at least surprised us, and I think sheds a light on a lot of market pricing that's happened during the pandemic, which is that what the demand surge was extremely focused on goods. So at the same time that goods demand was surging, services demand was falling. we're now running, multiple years ahead of trend on goods demand. I think the number for the US in terms of percentage of consumer spending is now 35% on goods. Traditionally, it's been 30. That translates to something like $800 billion a year of extra stuff, which if your basement looks anything like mine would resonate in terms of all the junk that we've accumulated over the last couple of years. And I think that traditionally goods and services consumption have been very highly correlated. And that correlation totally and completely broke down, and that caught a lot of people flat-footed, even caught all of our equity analysts flat-footed. It turns out that that US equity prices are much more closely tied to goods consumption than they are to services. You think about a lot of your services that you've foregone, haircuts, restaurants, concerts, that's not really linked to large corporates, whereas the goods really are linked to large corporates. That goes a long way to explaining the surge in earnings. And I think that whilst overall demand may have been somewhat impaired because you had high goods and low services, no one had really figured out that what really mattered for a lot of these variables was the good side of the equation. And I think we have a much better understanding of that now.
And I'm going to go out of order because I know that you just pushed a button for Mickey Levy. So even though my next question's to Nida, I'm going to let Mickey talk a little now, because my recollection was maybe it was as many as 9 months ago that Mickey started pointing out, and also I think there was someone in the Fed system too, who was pointing out that owner equivalent housing rental component of services, which is I think maybe the biggest component of services in the PCE and the CPI, was already baked in the cake, going to rise dramatically. And so that it was, even though it lags in being included in the index, it was absolutely forecastable. So actually my view was, gee, why was it surprising given that services had such a big forecastable component? Could you talk a little bit about that, Mickey? Because I know you were an early identifier of that component.
Sure. To Jeff's point, I mean, yes, we had an absolute surge in goods consumption, while services were by the nature of the pandemic slow to catch up. But completely consistent with that, we've had goods inflation double that of goods of inflation of services, and you just see that looking at the just the simple components of the PCE price index. So Charlie brings up this critical point when we think about services, which are over 2/3 of the economy and inflation. The biggest component is the shelter costs, and so I don't know when a while ago I just estimated a simple vector autoregression analysis, which showed that that the OER, the owner equivalent occupied rent, and the rental costs lag Case-Shiller home prices by 14 to 16 months using data going back to 1984 when it was first used, and projected that the biggest component of inflation, the cost of shelter, was going to go up to about 6%, like double from when I first estimated, and stay there for a year because of the lags. And then if you think about the rest of services, what do all these services sectors have in common? And it's not just leisure and hospitality, but it's medical services and personal and business services. Well, they're all labor intensive, and labor markets are just tight as a drum, and real wages are declining. So we can expect an acceleration in services. And I quite frankly, I'm baffled how the Fed could possibly believe inflation's going to come down now like they say it will. And I see, once again, I see a lot of people in the media just kind of buying into that, and the markets seem to be buying into it. And then, Coral, I want to respond to one point you made. You said you focus a lot on minorities and the challenged groups in society. Well, I wrote a piece in the Wall Street Journal, almost a year ago, saying that the higher inflation has the biggest negative impact on middle and lower earning workers, and we need to address it. And this issue about inflation shouldn't be tied up in political rhetoric like it has been, because it's having the biggest negative impact on exactly the people we're trying to help. And I still can't get anybody from the media to write about it.
Nikki, I'm going to come back to you with another question for a lot of the panels, but let me move on to Nida with one question. And I also want to reveal that Nida and I are co-authors and friends. So when I put her on the spot, everyone won't think that I've got something in for her. So Nida, there's also been a change within the Fed in terms of over the years in the way that dissents have been expressed or not expressed. And actually, since the 1990s, dissents have not been very common. Esther George, the president of the Kansas City Fed, has been a pretty confident dissenter until recently. In recent years, she hasn't really dissented very much. Many people say it's to create more of a sort of cooperation within the Fed. But then recently, I noticed that she made a comment about the need to keep an open mind about the balance sheet of the Fed, not just assuming that it won't contract. That seemed to me to be a very interesting sort of public comment. So I know that you may be constrained in what you can say, but could you talk a little bit about the role of the Federal Reserve banks as a source of dissent? Because that's what they were created to be in the Fed system, a source of independent thinking and dissent. But I don't think I'm seeing that very much, even from somebody like Esther, who's traditionally been a dissenter. What's going on?
Okay, yeah, I will say a couple of words. I'm not going to talk too long on this, Charlie. But before that, actually, I just want to mention that my colleagues at Dallas Fed last summer, Zhu and Dolmas, maybe that's what, Charlie, you were mentioning. They actually highlighted the rent inflation and how it may actually push up inflation further in the coming years. I just wanted to bring that up. In terms of your question, I think definitely. So part of the reason the regional Feds are structured the way they are structured across the country is for diversity of views. And Esther is a big proponent of this. This is at least how I feel at the bank, working closely with her, but also like the research departments at the reserve banks. I mean, there's quite a bit of diversity and independence in terms of what, for example, they are looking into, and which is not surprising, right? Given that our economies are quite different and diverse. So that's, I think, kind of like my general view as a researcher and as a part of the research department of the KC Fed, Charlie. But in terms of like the diversity or your points about maybe you don't feel like you're not seeing, a lot of independent views or diversity. I don't know. I mean, one interpretation could be just like, at least over the past couple of years, like just looking at the interest rate projections in the SAP, I think the dispersion I think has widened, if I'm not mistaken, right? I mean, to me, this kind of highlights to some extent that at least underscores that there's diversity of views regarding what monetary policy should do in response to the current outlook, right? So
it's a really good point, Nida. Yeah, I mean, it's a good point that in some sense it's replaced the outspoken dissents to have the actual quantitative dissent in the scatter plots. That's an interesting point. I'm going to exercise some forbearance. I'm going to ask one final question and hope that I just get very short answers, mainly from the Economist, but Coral, also feel free to weigh in. One of the things that strikes me as strange is there's something that I have always called the Taylor principle, which is pretty much if the real interest rate is falling, monetary policy is becoming more accommodating. And it seems to me like the pace of interest increases, if Mickey's right, inflation's going up faster than the nominal interest rate. Doesn't that mean inflation will accelerate? So I want to ask everybody to kind of weigh in on that. I'm not asking you to forecast anything. I'm just saying, do you agree or disagree with the proposition that if nominal interest rates, in fact, are going up slower than inflation, doesn't that mean monetary policy is becoming more accommodative and therefore inflation will be accelerating from that? So let me let everybody, why don't we start with you, Jeff?
Well, I think that what you said sounds to be somewhat, I would say, tautologically true, with the one exception that that spot inflation, and where I would think more about where we expect inflation to be 6 or 12 months forward rather than where it is right now. It's certainly true about where it is right now, but actually, like I go back to my earlier comments, I think that underlying both market prices and I think expectations for interest rates is the notion that this surge is in fact still transitory and will fade very rapidly. That is, I think, how you square the circle between thinking that rates won't have to go dramatically higher, yet inflation is currently at 8%.
Mickey, do you want to take a crack at that?
I mean, the issue is how much does the Fed have to?
You're breaking up a little, Mickey.
Can you hear
Sorry,
me?
we didn't hear you, Mickey.
Okay, so the issue is how much does the Fed need to raise rates to, to slow down aggregate demand, and the issue is a lot more than the market expects. And if you look through history, you can go back to post World War II, and you find that 100% of the time, when the Fed has to tighten after periods of ease, they raise the funds rate above inflation 100% of the time. And so, so I'd say inflation, oil prices are going to flatten out or whatever, food prices are going to flatten out. So even when the supply constraints ease off, the issue is demand. And I think inflation will come down from some level, but are we all going to be satisfied when inflation only comes down to 4 or 5%? I mean, I think that's the issue. So I think the Fed has to raise rates. And once again, I think the media can play an important role in this, because the Fed is tiptoeing along for a variety of institutional reasons, and the media can ask some open questions about this, and now the whole rage is, the yield, that means things are slowing down. Well, I just encourage the media just to take just spend a half an hour looking at some of the good research that's been done on the yield curve and the funds rate, and they could ask the Fed some really pressing questions that we can all learn from.
I think I'm going to ask the organizers to help me with the time clock here. I'm not sure, we may have started a little late.
No, we started basically on time. We've got about 15 minutes left.
Good.
I mean, it would be good to
So,
leave some time for the audience as well.
That's what I was hoping. Why don't, can someone navigate that for us?
I mean, you could navigate the questions and call on people if that's.
Yes, I'm not seeing, now I'm seeing it. Yeah, Evan.
Yep. Hi. I have a two-part question. First is more to Mickey. Can you hear me, by the way?
Yes, I hear you fine.
Okay. As someone who has been a long-time believer in the quantity theory of money, I am not at all surprised that the dramatic increase in the money supply has resulted in inflation. But that then raises a question: why didn't the significant increase in the money supply after the 2007-2008 crisis also not generate an increase in inflation? And I wondered if the answer is that because of Basel regulatory requirements, banks had to materially increase their liquidity holdings. So the available for sale portfolios of banks grew, and that was really a kind of frozen liquidity that wasn't being spent. So would it be correct to say that the reason we didn't see a large increase in prices, even with the huge increase in money supply after the 2007-2008 financial crisis, was that that increase tended to get absorbed and frozen in just materially increased liquidity requirements of financial institutions?
Hey, Evan, I think that's a partial answer. But I think it's a great question because everybody presumed that inflation would stay low like after the financial crisis. Why didn't it? The Fed never answered that question, and the media never asked the Fed to answer that question. Well, so if we think about it, following the financial crisis, the Fed engaged in QE1 and QE2 and QE3, and you had an explosion of the monetary base, that is reserves plus currency. But for a variety of institutional reasons, including capital regulations, liquidity regulations, and the like, you saw all of the increase in bank reserves stay in the system as excess reserves, and banks just lend it back to the Fed. So slosh back and forth between the money center banks and the Fed, and it never was put to work in the economy. So if you look back at that period, there was an explosion in the monetary base, but not an M2. Now fast forward and so we never saw any acceleration in nominal GDP. It never got put to work in the economy, so inflation stayed low. The Fed still doesn't understand that. Okay, tongue in cheek, the reason why the Fed's policies worked following the financial crisis is because they didn't work. Okay, now fast forward to the current situation. You had this very interesting confluence between the Fed easing aggressively and unprecedented deficit spending through transfer payments, a large portion of which was saved and left as bank deposits. And so you saw this explosion in M2. It's increased 40%, and it's just sitting there, and you see this, reflected in excess savings by households and businesses. And so, yeah, I think you're partially right, but this is not rocket science. I mean, what is M2? It's bank deposits. It's sitting there waiting to be spent. And so it's these simple issues that the media never brought up and hasn't asked questions about it. And the Fed is just blind, because what's so striking is the Fed is supposed to be conducting monetary policy. God forbid anybody at the Fed ever should mention money.
Yeah, and in addition, the velocity of money fell very dramatically, as implying that initially no one was spending it, but there was this huge increase in cash in personal accounts, that once people started spending it, once the velocity of money started going back anywhere near to what it had been, that necessarily would result in increased demand, and that would generate higher prices. Do you think that's...
Yeah, so I don't want to hog the discussion. I wish I could continue this and love to get Jeff's input, because my feeling is the story isn't over yet. Meaning, households are sitting on $2.5 trillion in higher savings than they were. Businesses are sitting on more accumulated savings than ever in history. Are you aware that state and local governments have become one of the largest holders of treasuries? They were given over $500 billion in federal grants, and they haven't spent any of it. And you see standard, mainstream economists saying, oh, budget deficits are coming down, so there's no more fiscal stimulus. Are you crazy? So so the story's not over yet, and we need to keep talking about these issues. And I think the media could help a lot in exposing a lot of these very interesting issues.
I think this is an important point, and I'm glad you brought it up, which is the fiscal stimulus isn't over. And there's a lot of forecastable stimulus coming from municipal governments too. I don't see any other hands up. Maybe I'm missing someone. So if your hand is up, why don't you just intervene and take yourself off mute and ask a question? Not hearing any, I'm going to let the other panelists weigh in as they one more round. Why don't we start with Coral? Coral, is there anything you'd like to add?
Yeah, just to emphasize again, right now, I mean, it wouldn't be responsible of me to forecast anything, but I think the important thing and the responsible thing to do is, as Mickey said, just pose the question moving forward. I think that's the most important thing that a journalist can do. And even though I think it's more important to highlight and report something for maybe a historical archive purpose, but to say that we did pose the question, to say not because of readership or clicks or anything, but because we did try to answer this in, or maybe not answer, but pose the different types of ideas in terms of what's going on, and say that we did try to address this question, and just moving forward, keep doing it with that in mind for the reason that we did report on it, and to do it responsibly as well.
Let me go to Nida, because you haven't had as much a chance to talk. Is there anything you want to add, Nida?
Yeah, absolutely. I mean, as just had been discussed, I think I'm with Mickey in the sense that going forward, probably looking at, the inflation components, probably at some point, for example, energy, or let's say even autos may actually kind of like flatten, at least stabilize, even if, let's say, reverse. But there are other components. Then we mentioned about rent, because I mean, it's pretty much like almost every component now kind of like rising. And rent is definitely particularly interesting, looking into, for example, Zillow new rent units, they're accelerating higher. So meaning actually it's probably not going to actually peak anytime soon. So it's going to take, for some time. So as a result, I mean, just we're watching some of these components where they are heading and etc. And what I just want to add something about your point on this negative rates, Charlie. I think it's not that, and I'm not an expert, like how, for example, these monetary policy tools exactly actually affect and feed into the economy, how fast. But I think it is missing the information on the outlook for the balance sheet, right? It is not just about, short-term interest rates or what the path is going to be, but it is also, for example, like the balance sheet, how, like fast the, like reduction will take place. I mean, the committee communicated regarding this recently, but I think it is, I mean, you cannot at this point really describe the stance of monetary policy, just, I guess, looking at the projections, for example, of the funds rate. So I will just leave it at that. Thank you so much.
Jeff, I think we'll let you have the last word.
Sure. It looks like there might be one or two other questions. I don't know if you want to let anybody.
I didn't see them. Maybe they came up. But in any case, I still don't see them.
Looks like Paul, I don't know if you have a question.
I do, but Maggie was first.
Oh, sorry.
Maggie, do you want to unmute yourself? Okay, I'll go first, and Maggie can go second. Oh, there we go.
Please go ahead. Go ahead.
No, you first.
Okay, I wanted to react to Charles's question about rates being, the increase in rates being below inflation, and wouldn't that just enhance the inflation effect or accelerate the inflation effect? And one of the things I remember from decades ago, maybe at Columbia, is that, and that was really decades ago, is that in an inflationary environment, you protect your wealth by borrowing and paying today for things which will have higher value tomorrow, and you'll be reimbursing the money with less valuable money. So it's obvious that if the rate at which you're borrowing is lower than the rate at which the goods you're buying will be increasing in quote unquote nominal value, it's very obvious that just turbo drives that effect. So turbo drives a mechanism of buying more and inflating more. So I really appreciated that question. I had not perceived the problem in this way before. The real argument against the Fed's behavior today, I hear from a man called Ray Dalio, which is that it's destroying wealth and it's destroying savings to the extent that it's impoverishing people getting a return of 2.5% when their money is losing 7% or 8% value every year. But in addition, it creates a turbo effect on the inflation. I just wanted to add one last thing. It was more of a reaction than a question. The one last thing is that I was right before COVID. I happened to be in London. I think it was at the British Museum. And I didn't like the main exhibit. So I went to a very peripheral exhibit because I'm interested in money and what money means, about the interbellum money printing in Germany between the two world wars, and the extent to which the desperation of local governments in trying to raise funds or have money resulted in this massive printing that was way out of line with the economy. And we've all heard stories of the wheelbarrow loaf of bread, wheelbarrow of cash to buy a loaf of bread, and the extent to which that hyperinflation. When we experienced the Fed easing that we observed this year, I was quite shocked to see that that small exhibit was a precursor of things to come, and that we were about to live this in our own life. To my amazement, I couldn't imagine. I thought it was such a strange exhibit, and here I am living it. So yes, knowing history really helps. So I was not shocked by what's happening, Mickey. Yes, I was ready for it. But indeed, I think a lot of people weren't. I would add one last thing. I am not sure that the media should warn people, because one of the problems with inflation is that the more we are aware of it and trying to protect ourselves from it, to some extent, the more we drive it. So I must say that a reticent media may have not been all bad. Thank you.
Paul, you have a question or a comment.
I do. I think Maggie makes a great point about the media calling attention to inflation, because there's a lot of research indicating that the media actually is a catalyst for people updating their expectations. And I think we'd all be pretty happy if people just left their expectations in the past with inflation. So, I think that's a really good point. I also just wanted to ask a basic question to Nida about the measurement of real rates. And I wanted to know, given that break-even tips inflation rates are for 5-year horizons are like 3.5% right now, what's the right measurement of inflation expectations for measuring real rates, right? Because it's easy to say real rates are nominal minus inflation expectations. It's much harder to actually figure out what inflation expectations to use. Do we use the 5-year market expectations, what horizons are we using, and we just believe the market, or do we have our own forecasters and look at surveys?
Thanks, Paul. I think that's a great question. I mean, at least I have been, or we have been looking, tips is kind of, I think, one of the favorite measures among, I think, policymakers as well. For example, James Bullard, I remember putting like a post mentioning like, tips. I mean, we have other measures that we pay close attention. I personally always look at, for example, consumer inflation expectations coming from New York Fed or University of Michigan surveys. And I think there are other measures, but I guess in terms of like the real rates, I think that the tips is kind of like what at least I have been looking into, but others definitely can jump in, because I mean, it is not, I don't pay a lot of attention to these. My focus most of the time on the other developments in the economy, but yeah, I will leave it that. Maybe others can also add if they have other suggestions.
If there's a short add-on, please, anyone else, feel free.
I would say that that in times when gas prices are going up quickly, we find that consumer surveys tend to be unreliable. They tend to dramatically overweight the importance of gas. And so in those periods, we definitely prefer to look towards market measures rather than the survey measures.
Hey, Paul, if you weren't such a stellar academic and actually worked in the private sector and were renegotiating a wage contract for your labor union, would you go in very happy with the 5-year forward? Or would you, yeah, of course you wouldn't. So I think the critical issue about inflationary expectations is how is it forget about how it's affecting Wall Street, but think about how inflationary expectations are affecting wage and price setting behavior in the non-financial sector. That's the critical issue that I think there's a divergence between what the Fed looks at and what's actually happening. And I just end by saying, you know, Maggie's point, the difference between the current situation and what happened in the 1970s and then what happened earlier in the Weimar Republic is the difference in inflationary expectations. And if we should start seeing a rise in inflationary expectations embodied in bond yields, then you're going to see an acceleration in money velocity, and then the wheels come off the system. So inflationary expectations are critical, and the Fed is much too sanguine about how to measure them, how they're falling back on, you know, their standard, you know, tips, break evens, and not thinking about the real risk they face here.
Well, the organizers are going to have to exercise some discipline on me. I think we're probably close to out of time.
Yeah, that's right.
And so I just want to thank the panel and thank the audience for participating in this very lively and informative discussion. Thanks very much.